Welcome to Money Convos, where we discuss personal finance and investment tips. We are committed to helping people create wealth and achieve financial freedom. Follow us on Twitter, Instagram, Clubhouse, and Facebook, and subscribe to our YouTube and podcast. Alright then, let's head into today's conversation.
Hello everyone, and welcome back to Money Convos. Today we are diving into a topic that every investor should feel confident about: reading and understanding your investment statements. And we are so glad that you decided to join us today. So whether you are just getting started on your investment journey or you've been in the system for a while, it's very important that you know what's happening with your money. So it's true, you could have received your investment statement and felt completely lost, and you are not alone. We've all been there. And so, as rational as we are, we also take a look at our balances first. How much am I earning? How much has my money grown? And we ignore a lot of things on those statements. So today, we will attempt to look at the tiny bits of the statement that you should also pay attention to, that mean a lot. And you end up realizing that understanding these statements is also key to managing your investments. So today, as always, I have with me Adam to have this conversation. Hi, Adam. How are you doing?
Hello, Dennis. I'm doing good. Can you hear me clearly?
Loud and clear. Very nice.
Good.
Lovely. So let's just get started. So first, let's take a look at some of the components of a generic investment statement, right? And before we start, it's advisable to note that none of our discussions here constitute a professional investment advice. And if you would like professional investment advice and counsel, please talk to your licensed investment advisor or your investment house. And so, whilst we get started, let's look at the basic components, right, of our statements. So when you take the statement from a couple of investment houses, you would notice that each of them have a different template or different structure to presenting your statement to you. However, in this conversation, we will attempt to cover the most common things that can be found in almost all of them, so that once you pick a statement, you can make meaning out of it. And so one of the things I noticed that cuts across is an account summary, or a summary of what has happened, what has transpired on your account. And so this is often the first section you see, right? It provides a snapshot of your account, including your balance or your cash balance, and probably some may denote it with available funds. And so these terms might seem similar: account balance, cash balance, available balance, but each of them serve a different purpose. And so simply, the difference between your account balance and your cash or available balance is that your account balance reflects the total value of your investments and your cash combined. So you could have investment in your account with the investment house. There could also be cash sitting in there in the account which is not invested yet. And when you combine that, that is your account balance. But your cash or available balance refers to the amount of liquid money that you have available for new investments or withdrawals. And so, Adam, I don't know if you've noticed any other thing in the account summary side or any variations to what I've said.
I think basically that is how a lot of people put it there. And some to the account summary, you'll find, especially if you are kind of like invested in different kinds of investments, they might have it something like a breakdown, a summary of a breakdown, maybe, as you said, cash in your account. There may be the investment that is in one particular type of investment and then another type, or the various breakdowns. Depends on the type of statement or the kind that you are looking at. Other times to the summary over there, you might also find a breakdown of your account activity, maybe the kinds of deposits you have done, or if you have done some withdrawals. Yeah, sometimes you find it in that, depending on how it's structured, you might find it under that section. Yeah.
Very good point. Very good point. So just like Adam said, sometimes you may also see your transaction activity in your account summary. And this shows a list of all the activities that have gone on in your account. So whether it's buying in securities, selling securities, receiving dividends, receipt of interest, paying of your fees, all these could be summed up in your account summary. And as said earlier, there isn't one structure to the account summary. It could be presented in a lot of forms. But once you understand that this is a summary of everything that has gone on in my account, you can be better informed to make decisions going forward. And another also important thing you can see on your statement is your holdings. So in previous conversations, we've mentioned that as a prospective investor, there are a lot of options available to you. You could buy stocks, you could buy bonds, you could buy into mutual funds, you could buy into exchange traded funds, and a whole lot more. And whatever you buy through your investment house or investment advisor may be shown on your account statement or your investment statement. So the name of the company whose stock you bought, the name of the companies whose bond you bought, or the name of the government whose bond you bought, the name of the ETF that you bought, or the name of the mutual fund whose shares you bought will be shown on your statement. The value that you bought will also be shown there, as mentioned earlier. It will most likely show your purchase price, which is how much you originally paid for each stock, bond, or share of mutual fund that you have, and the percentage change since your purchase. And understanding this really helps you. It helps you to track your investment performance over time and whether the holdings that you have in your portfolio is working for you. I don't know, Adam, if you have any other comments on the holding section.
I think basically you've captured most of it in terms of the price at which you bought it, the kind of investment. For example, if it is a stock, how much you bought it for, and if it is you are actually looking at a current statement, then mostly you would be seeing how much you bought it for and then its current value as at now. So those are some of the things you'll be finding, so that you are not confused between how much you bought it for and how much it's going at the moment. You need to be able to relate those two prices. Yeah, I think those are the main thing I would want to talk about that. Yeah.
Yeah, thank you so much for adding that. And so another thing you may also see on the statement may be an overview of your performance. So you could see your year to date. You could also see your held to date return. You could see your annualized returns or your cumulative returns. Each of these have their own meanings, right? So basically, your year to date return shows you how your portfolio has performed from the beginning of the year to the current date. So if you want your year-to-date return today, it would take the performance of your portfolio from the beginning of the year, that is January 1st, 2024, till today. That's your year-to-date return. You could also see your held-to-date return, which shows the performance of your investment from the date you purchased it up to the current date. So you may not necessarily have bought your investment or done your investment at the beginning of the year. How your performance has done from the date you bought it till today. So there may be a variation with your year-to-date return and the held-to-date return. There's also the annualized return here, expressed as a percentage. So, for example, you could say, let's say your portfolio has grown 30% over 3 years, right? If you want your annualized return, it might be around 9% per year. So the annualized return shows you how much your investment has grown each year, expressed as a percentage. So you could say over the 3 years, 2021, 2022, 2023, my investment grew averagely 9% per year, which is also a very good metric to judge the performance of your portfolio. And also, you could also see cumulative returns, which reflect the total growth or decline of your investment over a specific period without adjusting for time. So some people want to see just maybe they bought a stock in 2015, 2016. They just want to see their returns showing the yearly growth till today, which is also a good metric with which you can make your decision. So each of these have their own meanings, and it's good to understand them such that when you get your statement, you're able to make meaning out of them and ask your investment house or investment advisor meaningful questions to help you make better decisions and improve the performance of your investment or portfolio. And another part which is very important that people may ignore is the fees and expenses. Adam, I don't know if it's a similar experience you've had, that you may ignore the fees and expenses part of your investment and then just move straight to how much you've made.
Yeah, I started paying attention at one point in time, and I realized how much fees can be a lot, especially if you are dealing with a lot of money. Okay, even if the money is not that much, I mean, cumulatively, you would be having these fees deducted, and sometimes people don't pay attention to the fees, so it's very important, especially if you are dealing with a mutual fund and you need to know whether it's a front load, or it's sort of like, it's whether it's front loaded or it is back loaded, in the sense that is the fee at the point of purchase or is it at the point of redemption? Those are very important factors to know, especially if you are buying a particular mutual fund. So when you pick your investment statement, you see, for some people, they clearly write it the fee, some to say load. So if you see load, you should know that it's basically like the fees too, so that you are sure and you know what it is about. Because I've had an instance where some people will tell me that, oh, I bought this mutual fund worth maybe 100 cedis, but when I check my balance, they are saying it is 90, maybe 95 or like let's say 97 cedis or something, and they don't seem to understand. It's the loads or the fees which are charged. For some, they don't charge anything upfront. Some they charge upfront, and so you should know these two differences. And when you pick up your statement, you should be able to find it clearly stated over there. Yeah.
Very excellent points, Adam. Very excellent points. And just like Adam mentioned, it's important for you to know what you are being charged for, right? It's important for you to know whether it's a management fee, it's a trading commission, or in the case of mutual funds and exchange traded funds, whether they are expense ratios. So basic understanding of these, what are management fees? Management fees are the annual fees you pay to your investment manager. They are the fees you pay to your investment manager or the fund company for managing your investments. So typically, if a fund has a 1% management fee, that means you pay 100 cedis every year for every 10,000 cedis you invest with them. That is the management fee. You pay that for them managing your money. And also, there could be trading commissions. That is normally seen when you buy or sell securities like stocks or ETFs. So this is a fee that it is often charged by a broker for processing the transaction. So some investment houses offer commission-free trading, but there are still investment houses that take their trading commissions. So that could also appear on your statement. And another very important one is your expense ratio. So basically, it's they are ongoing fees, right? Expressed as a percentage of the fund's assets. So, for example, an expense ratio of a fund or a mutual fund could be 0.50%. And this means that you pay 5 cedis annually for every 1,000 cedis you invest in the fund. What's the benefit of lower expense ratios? It means it can help you retain more of your investment returns over time. And so for people looking to invest in ETFs, mutual funds, this is a good metric with which to judge which fund charges you less. And so you would notice that most of the prominent ETFs, most of the prominent mutual funds, they often pride themselves on having lower expense ratios. It's a very good metric with which to judge your prospective investment before you go into it. So all of these are potential things you could see on your statement. And again, we stress on it that the structure of the statement may differ from investment house to the other. But then once you understand all these basic terms, you'll be able to make meaning out of whatever is presented to you, right? And also there are some other key terms. So what if I bought a bond? You could see yield on your statement. And the yield is very simple. It represents the annual interest payments you receive as a percentage of the bond's current price. So let's say if you bought a bond for 10,000 cedis and the bond pays 50 cedis in interest annually or in coupons, your yield then will be 5%. So it's just dividing the interest you receive annually by the face value of the bond. Also, for dividend paying stocks, the yield shows you how much dividend income you've earned compared to the stock's current price. So you could hear terms like dividend yield. What they attempt to do is just divide the dividend you've received or you are entitled to receive in the year by the stock's current price. And this can be computed going back in time. So these are common things you could see on your statement and ways that you could make meaning out of them. Also, there's capital gains. And I don't know, Adam, if you have a simplified explanation for capital gain.
Hello, Dennis.
Hi. You're loud and clear, please.
Yeah, I missed the last part of what you were saying about capital gains.
Yeah. So, in a layman's term, what would you say capital gains are?
Oh, okay. All right, yeah. Yeah, so for capital gains, basically, it's like, let's say, okay, you bought a phone let me just use a phone example. You bought a phone for, let's say, 1,000 CDs and, you've held it for some time. And in Ghana, things work in a very funny way. So maybe a year later, the value of the phone on the market has gone up to, let's say, 1,200. You have made a gain of, the value of the phone is now 1,200. So if you should sell it and then now you make that gain of, let's say, 200 CDs extra, that difference is your capital gain. Okay, that the price at which you bought it is basically calculating the price at which you are selling, subtracting the price at which you bought it, and then that gives you that gain. If you can express it in percentage terms too, and that will also give you some percentage rate. Yeah.
That's brilliant. So, just like Adam said, when you sell an investment for more than you paid for it, the profit you gain is capital gain. And just like he said, you may have bought a stock for 100 cedis, later sold it for 150 cedis. The capital gain is simple. Your 150 cedis less your 100 cedis that you paid for it, and that's your 50 cedis. So capital gains are also very simple to understand. And once you see them on your statement, you should be able to make meaning out of them. And so, Adam, a sample question that people may ask will be, okay, what if I see all of these on my statement and I still don't understand anything at all? What should I do? What's the very first step they should take? Should they attempt to learn it on their own? Should they contact someone If you were in the shoes of someone who didn't understand any of these, what would you do first?
And so the first thing I think the first thing you should do, you are dealing with an institution. So if you don't understand anything that they have supplied to you, you should ask questions over there, first of all, and let whoever, whether it's a relationship manager or a customer experience officer or whatever, to walk you through basic ways. And I believe most people will take their clients through these things to understand. Okay, then afterwards, you can go and do some further reading if you need to understand it far better, and maybe talk to other people to explain it to you. But the very first thing you should be doing is to be talking to the institution from which the statement is emanating, because in the end, they are the ones who prepared it, and they are the best people who will explain it to you. Okay, since we know that even though all the terms, we'll find it in different places, but we realize that every institution and the way they present it. So it's best you talk to them and you understand what is happening to your investment. Then later on, for your own benefit, you can also go and do some further reading, further checking on the internet to understand other things better. But you should speak to your investment house. It's very, very important. Yeah.
Wonderful. So you will keep repeating. If something is unclear, please reach out to your broker or investment advisor or investment house, and they often provide a lot of services for these. So please don't hesitate to do so. And maybe you are also an investor who doesn't check their statements, right? But you should, ideally, if not every month, at least every quarter, you should at least check your statements. Ideally, you should check it monthly to see how your investment is doing. And there may also be significant market events in the market. We know in Ghana, it happens once in a while, but you may be living in the US or the UK or anywhere in the Europe, and where significant market events happen out of nowhere. So it's very ideal to be checking your statements almost every month. If not quarterly, at least almost every month you should be checking your statements. And also, there are other tips that we can go through. And so another very important tip is to not panic over short-term market fluctuations. I know we said monitor your investments monthly, and one side of it is you may not see any appreciation in the value of your investment month to month. Maybe the person checking quarterly to quarterly may see more improvements or maybe excited at the end of each quarter than you checking every month. And that's fine. I mean, we've had conversations about investment being boring and not very exciting and being in the market for a long term. But then don't panic that your investment is not going in fast enough for you, or if something happens in the market and there's a slight dip in your investment. It's always good to remain calm. As mentioned earlier, speak to your investment advisor or investment house. Get a reasonable explanation for whatever is going on, and then focus on long-term performance rather than being caught up in short-term volatility. Otherwise, you end up having investment with so many investment houses, but not having any reasonable gains on your portfolio. And so, to recap what we've discussed today, it's been very brief, but then we've covered very key sections of an investment statement. We've simplified some common terms that you may see on the statement. We've said that the structure may not be the same, but once you're able to make meaning out of each of the key terms, you'll be able to understand whatever is going on your account, and then ask meaningful questions to your investment advisor, get meaningful insights, and make better decisions. And it's also good to review your statements regularly. If you can't do it monthly, at least check in with your investment house or investment advisor quarterly, such that you can make your goals for the next quarter. And also remember that understanding your investment statement is very key to staying in control of your financial future. you need to know where you stand in life. An investment statement shows you where you stand in terms of your investment journey. And so, as you said earlier, once you get your statement and you have any questions at all and want to dive deeper into anything on your statement, reach out to your investment advisor or investment house. And speaking of understanding the basic terms, if you just got started on your investment journey, looking to understand the basic terms in the industry, please, when you get to Instagram, reach out to investment friend. And it's always good to have a friend on your journey to financial independence who will hold your hand and give you the right tips and opportunities. The investment friend will keep you very informed. And please, if you have any questions, investment friend is just a DM away. So send us a message and let us help you on your investment journey. And so thank you so much for joining me today. And thank you, Adam, as always. Thank you, Mimi and Mr. Beckley, as always, for always tuning in to join. And if you found this episode helpful, don't forget to share it with your friends and family. And you can always play back this conversation right here on X, YouTube, or wherever you listen to your podcast. Just search for Money Convos and you can listen into all the previous conversations. Next week, we have a very exciting conversation for you. So please don't go anywhere. Until then, stay informed, stay confident, and take charge of your financial journey. See you soon. Bye-bye.
Thank you for taking the time to listen to our thoughts. I hope you learned a thing or two and start practicing. Don't forget to follow us on Twitter, Instagram, Clubhouse, and Facebook. And subscribe to our YouTube and podcast. Do tell a friend about Money Convos so we all become wealthy together. Talk to you soon. Bye.